Hello, everybody. It seems like we are up and running. We're going to give it just a little bit of time as participants begin to file in. Participant number is still ticking up, so I'll give it a little bit more time.
Okay, so that sounds good. And for those on Midwest time, it is 12:30 Midwest time, 11:30 Mountain time. And thank you for those of us joining from the West Coast on Pacific Daylight Savings Time, where it is 10:30.
And it's 1:30 where I am. It's also about 95 degrees. Okay, cool. It seems like we've hit a quorum, so I think we can get started. I'm sure people will begin to file in. Few housekeeping items. If you want CPE, we are going to have 2 poll questions throughout this. Please just respond to them. It's just something so we can measure that you actually attended. If the polls do not show up, please do not worry. After the presentation, you can reach out to Hillary, who sent out this invite, who will be able to get that all straight for you. It generally has to do with whether you're using Zoom in the browser or the Zoom app, but it's an issue we've seen before. There's no concern. Also, please be sure to fill out the survey that will be sent to you at the end of this presentation. That really provides a lot of meaningful feedback for us. In fact, the presentation Jordan and I are about to do right now was based on some of that feedback that we received. So today's presentation is going to be about navigating state and local tax assets during difficult times. We're really going to jump all over the place. If you've ever seen Jordan and I speak, it's going to be potentially contentious, a lot of disagreement. And while we will get into sort of state conformity to the CARES Act, what we're really going to do is spend a lot of time talking about kind of due diligence, examining your current positions, and figuring out where you can either patch up areas of risk or pursue areas of opportunity. And then, most importantly, I hope everybody is staying safe and healthy. We know there are a lot more important things going on in the world right now than talking about state and local tax assets, including, protests in my city, sort of representing the truism that Black Lives Matter. And it's, I don't want this to be seen as flippant or dismissive, but we do state and local tax, and we are going to, I think, have a lot of fun for the next hour. So with that, just kind of getting into the meat, I want to start with one of our poll questions. Have you attended any prior HMB webinars?
Like we said, these are really tough questions, so really think about them.
Okay, cool. So we've got quite a few people. Votes are still piling in, so I'll give it a few seconds, but quite a few people for whom this is their first. So 50% attended one. We've got 17%, all of them. So these are our star attendees, and I'm really happy to know that this is some people's first, because we really do want to try to expand our scope and reach as many people with these as we can. So getting into the agenda, like I said, we're going to start by reviewing previous filing positions, really with a mix of where are opportunities to pursue and where are areas that you should examine to make sure you're not unnecessarily exposed. We're really going to get into the weeds on some of this, but things like alternative apportionment, the transition to market-based sourcing, these are, just really thorny areas that have created a lot of opportunities and a lot of confusion. I'll talk a little bit about the CARES Act changes and the conformity or lack of conformity to that on the state side. And then we'll just talk a little bit briefly about credits and incentives. I don't think either Jordan and I would ever claim to be the utmost experts on credits and incentives, but what we have had a lot of experience with is just maintaining open lines of communications with states. I think that's a really important thing to keep in mind during all this. So with that, I will transfer things over to Jordan.
All right, thanks, Chris. And I appreciate that. And again, we appreciate you guys tuning in to listen to us talk. And I get the opportunity to debate with Chris almost on a daily basis and thoroughly enjoy it, and hopefully you will enjoy it as well. So just a couple of things that are, some of which are obvious, but some of which we'll get into a little bit. I hope we've all been able to take advantage of this. Certainly the remote working or working from home has taken us, a number of us, by surprise, but those of us in the state local tax area, it hasn't been as big a shock. A lot of us spend time on the road, and so we were ready to work remotely, but understand that the states generally are not, and a lot of things that they have been doing on a regular basis, it took them a long time to get up and running. And so we often have those audits where the auditor seems to disappear for periods of time, and then they come in and ask for a waiver of the statute of limitations. Expect a lot of that. What we're going to have is, and I'm of this philosophy in doing what we do, there's no such thing as vacation. You do a lot of work before you go, you do a lot of work and you come back, and during a period of time, you may not be as active doing the work, but the work doesn't go away. Same holds true with what our interactions with the state is going to be. We did a lot before they left. We're going to be doing a lot when they come back. It didn't disappear. So for those of you that had a lull in state activities, anticipate a lot of the states coming back with a vengeance when they get up and running and trying to continue on whatever the new normal is going to be. We're going to see a lot of the audits that have been paused kick in. We're going to see a lot of demands for statute of limitation increases because they haven't been able to address the questions. They've been working remotely. They can't get into their, for the longest time, we had confidentiality issues for people working at home where they didn't have secured lines. They didn't have secure availability into their databases. And so things just got put on hold. Similarly, here in Cook County, there is no time frame when litigation will really kick in. We just received another order kind of pushing all non-emergency type motions back to the end of the summer, to August.
March dates are now going as late as September.
Right. So, what this is going to create a backlog. And one of the things you're going to have to deal with on the litigation front is, do you want to still litigate the case? And I know something that Chris and I run into all the time is impatience. We want to get going. We want to things, unless there's a tactical reason to draw it out, we want to get into court. We want to make our arguments. We want to move on to the next level. And things are getting backed off. And so one of the alternatives that are going to be out there is, do you want to have this decided just on briefs? Do you want oral argument? Motions for discovery may fall by the wayside. Some of the depositions you might do may fall by the wayside because there's fatigue associated with the fact that these cases have been sitting around. And on one side, one of the ramifications of it is, what happens to the accrual of interest during this time? For those places where you don't have to pay to play, the interest keeps running. Well, from no fault of our own, this is going to be extended by 6 months, a year, 2 years. Who knows how long it's going to be ultimately extended? Who bears the brunt of that cost of money? Something that should be being addressed. Some states are addressing it. I know Chris and I have pushed back on some. They say, listen, this isn't our fault. We may have had the money, but there was nothing for us to do because the courts have told us we're not doing anything on this, so we can't get resolution. So one of the things will come out of this is the accrual of interest. How do we address it? I recommend, I know Chris probably does too, we're going to push back and say, listen, this is not our fault. This is, an act of God or whatever it is. We're not going to be paying interest for this period of time, or we want a relief from interest no matter what happens in the back end.
Yeah, and one of the things on the interest side that I think is an important distinction is there are some state departments of revenue that are simply saying, we are putting things on hold right now. We are not proceeding with certain cases. That's the Department of Revenue putting it in, putting things on pause. If a court says we're pushing things back, a department can say, we're in the same boat right now. We shouldn't be deprived of interest. But if it's the departments themselves saying they're going to put things on hold, I think there's a really compelling case for interest abatement. The thing a lot of states will say is that their hands are tied with respect to interest, right? That this is statutory and they have no authority to waive interest. Well, there's also various due process rights and things like that say you can't just put an audit on pause and artificially increase the assessment with interest.
Yeah, particularly when statute of limitations are being extended because you're ready to go, your records are available, you've given information to the auditors. The auditors, for whatever reason, either don't want to or can't get to it. We are going to push back on all those things on audits with the accrual of interest during this period of time, and it's something that you should consider. Understand this also, states you can't go a couple of minutes without some state or local jurisdiction telling us how much money they're not going to have during this period of time. I think the city of Chicago said that the current budget is $700 million for 2020, and it's going to be more than that in 2021, and they don't want to raise property taxes, but that's just the city. States are billions of dollars short, and there's only one way to really make up that money is to look to the taxpayers to pay an increased burden. They're going to be looking for money, but it does create opportunities as well. We'll talk about it in a little bit, but there's going to be tremendous settlement opportunities because cash in the door in the current fiscal years is going to be more important than the opportunity to perhaps get cash in a later fiscal year. So it is a really good opportunity to start looking at settlement possibilities. This is something that you really won't need to adjudicate. And as we always say, 90 to 95% of all state tax cases generally settle. Well, it might be worthwhile for you to initiate that now to take advantage of the state needing cash in the door, as opposed to trying to make a point, of course, unless it's an ongoing issue or the dollars are high or the stakes are high or you haven't reserved for it. But we are actually seeing states being more amenable to settlements. And in fact, something that you might be considering, something I've heard talked about by a number of states, are amnesty programs to bring cash in the door. Exactly what that does is it accelerates not the ultimate tax that they'll get, but it accelerates the time in which they get it. That's what amnesties do. They bring in tax dollars generally for relief of interest. And something I've been talking to my clients about is if states come up with these amnesty programs, and I think they will, sometimes you can pay on a higher percentage of the tax due if you get all interest and penalties waived. And the question I ask my clients, and I think it's the right inquiry, is does it matter to you, or is cash cash? Is $1 of interest worth $1 of tax? And if so, to maybe get it resolved, instead of paying 30 or 40% of a liability, maybe pay 50 or 60% of the tax liability, but you get the waiver of interest and penalties associated with it, so you're back at that 30 or 40%. And these are numbers that you guys should be taking a look at. And one of the things, and I don't quite know why, but we have 10 or 15 VDA programs going on in our office, projects going on in our office. People that I didn't anticipate ever wanting to do a VDA are doing VDAs for entities they've set up, either on the Wayfair side, the income tax side, the sales tax side, remote seller side, the CAT side, all different things. But there seems to be an increased propensity for people to come forward with VDAs, and it's actually a good time to do it. One is we like to create a project on it, and I have been involved in a number of them where just even on the income tax side where they just haven't filed. They never got around to doing it, and it just kind of repeated itself, and now they're 10 years out with perhaps significant historical liability. We've been very fortunate. We've been able to work with some taxpayers that had some good facts. We've crafted arguments for go-forward dates that isn't even the full extent of the historical liability. And in some cases, it's better than any VDA that you're going to get because of the facts and circumstances. We've worked with the clients. We've worked with the state. We're open with the state of what's going on. That coupled with, and I hate to take advantage of misfortune, but with the COVID environment, and the very survival of businesses due to COVID and businesses shutting down, states have shown some compassion in saying, if you guys can pay us before you go bankrupt, that would be great. And so we've been able to cut some deals based upon the viability of perhaps certain businesses and business models that otherwise wouldn't matter. But because of the shutdown of businesses on a national basis, and even if you're just for example, in the restaurant business, 50% is better than zero, but it's still 50% of capacity. That's just a cash flow issue. You're not making money. And how long can you sustain that? And the states are understanding no matter what business you're in, there is a possibility either from a supply side or from a customer side. You may not be around, and they've been very, not all of them, but a lot of them have been understanding that we're willing to come forward now, pay you X amount or for X period of time, not really tied to the VDA limitations, 3 or 4 years, and we've been able to cut deals on a go-forward basis or a smaller look-back period. The caveat I put out with this Washington administrative hearings, Washington has been #1 on my list of states that are just a pain in the butt for a long time now, and they continue to do this. This was someone who came forward with a VDA. Oftentimes we see what happens is you get an audit notice to a member of your group, and in a separate state, you treat each of the entities separately. But here, one member of what is allegedly a unitary group got an audit notice, kind of kicked the stairs a little bit, kicked the tires, and they said, well, we should do VDAs for all the other entities. They went forward with the VDAs and got to the last point, and the state said, well, wait a second, are you related to this company? You go, yes. Well, they're under audit, and therefore you're disqualified from the VDA program. We go, wait, Washington's a separate company.
Filing state.
Right, that doesn't make any sense. So they went to their, how do I say it in a nice way, their kangaroo court, the Administrative Hearings Division, and the Hearings Division agreed with the Department of Revenue, said, I touch one, I touch all. You don't get the opportunity to do a separate VDA. My understanding is this is a relative recent decision, that it's up on appeal. It doesn't seem, it's absolutely a horrible freezing effect on VDAs, and the whole point of a VDA is to get people to come in. It's called voluntary disclosure. And so you would think that kind of would have a very freezing effect on people coming forward, because someone might be complying, someone might have an audit, and how far does it reach? And I gave a presentation with Marshall Stromberg, who you may know as a former commissioner of Florida, was the assistant executive director for the MTC. He just retired. I gave a presentation. He goes, this is horrible. This is not something that the MTC would support. This is something that really eliminates an opportunity for both states and taxpayers to address historical liability in a meaningful way and get money in the door.
And it's definitely an outlier. I think most states, in my experience, are very happy to process VDAs and will work with you. Other states like Florida, for instance, will allow you to pursue a VDA on another tax. Even if you're filing income tax and you realize, oh, we need to be collecting sales and use tax, they'll allow you to pursue a VDA on sales and use tax. It's really only if you've been addressed for that specific tax within that entity. In the current environment, my experience has been the opposite of what Washington did, which has just been, hey, yeah, come on in. We're happy to have you.
Right. And then I just want to touch on one other thing. One of the things that we've noticed, and it's happened to us, is to the extent you've gotten audit notices through this period and you've responded to them, you have filed them either electronically or by hopefully certified mail, they're not necessarily getting answered. We had a situation in Ohio where we filed a number of protests, and the next thing you know is that our client got a collection notice because the protest had gone final and we had not done anything. And we were able to prove by certified mail, by receipt, by an email, that we had actually filed things. They had gone to an empty box, an empty desk, an empty area, and had never been processed. So collections didn't know anything about it, and they started putting liens on our clients. We were able to get them all removed, and they were apologetic, but that's not the only time that that's happened. Keep track of your filings. And, there's been a movement around the state about whether an electronic filing, electronic signature is valid. My answer to that is do it if that's the way you have to do it, and we'll deal with the results later on. To try to get things signed and then sent in as an extra level of hassle may not get done in time. If you're coming up on deadlines, get something filed and follow up on it. Keep receipts.
So kind of moving a bit more into the substance,
Yep.
Something that we mentioned at the top of this presentation is just, state corporate income tax rules have been changed a lot over the past 10, 15 years, I would say. We've seen a transition to single sales factor, to market-based sourcing, to combined reporting. And, a few presentations ago, Breen and I spoke on this trend, but we were talking really kind of in the weeds about, sort of specific apportionment rules in states, specific sourcing rules, specific ways that combined groups are constituted. What we want to do right now is kind of, let's take a step back for a second. We all know this, right? But what we also know is that in this process, most of our clients say, look, we're about to file in 35, 40 states. We are not going to come up with nuanced, unique approaches in every single state. It's triage, right? We're going to come up with the best uniform approach to define what the market is and define what COP is, and let the chips fall where they may. If we get audited, we'll deal with that when it happens. it's an important time, I think, to take a look at, okay, well, wait a second, what's going on with states right now? You know, whether it be the Sirius or the Lending Tree case or Honigman, these are all cases that have come out this year that we've already talked about before. But we know that they're reaching different results with respect to what income producing activity is, what market-based sourcing is. Now, on the one hand, you know, there's sort of a carrot stick thing going on right now. On the one hand, you want to make sure you're aware of those rules, that you're not running afoul of any of them. But there just as easily could be the possibility that there are opportunities in some of these states. And, you know, whether it be, where is the service received? Where is the service delivered? Where is the intangible received or delivered? These questions can have different answers. Where is the benefit? And so I think to the extent you zoom out and you look at what your state and local tax footprint looks like on a multi-state basis, there will be some states that you look at and say, that number just doesn't pass the smell test, right? I don't like the answer in that state. Ignore the law. It just doesn't make sense to me. In those states, let's do a deeper dive on, you know, okay, maybe you switch to market-based sourcing and you're just using, you know, one of Jordan's favorite go-tos to criticize, billing address, right? You're just using billing address and you realize that's not really where our customers are receiving our services or something like that. Let's drill down. And, you know, ultimately, we'll talk about this in a second, maybe you'll say, this is what the statute says, we need alternative apportionment. But it very well could be that, you know, I think there are 4 or 5, maybe 6 different ways states define the market. Examine that in the states that don't make sense to you.
Well, and something we've seen from these cases, 2 points I want to make is one, like in Honigman, where the statute said where the services were rendered, and the court didn't like that definition, said, well, rendered, performed. I don't think the legislator knew the difference between that. And, you know, for us as attorneys, you know, words are our art form. Everything is important. And certainly jurisprudence says that each word has to be taken individually for its own meaning. And for a court to say that rendered and performed are the same thing, to me was a little bit offensive in the Honigman decision. And I, you know, I say, well, if it's what's good for the goose is good for the gander, right? If they can look at words and say where the benefit is received, well, that doesn't really mean received, it means performed. Well, okay, so let's talk about that. And that's really looking at the way they define marketplace. I think that's open for interpretation. And we've always been a little bit confused, the difference between benefit received, benefit enjoyed, service received, service enjoyed, service rendered, and they're all supposed to gather this marketplace, which I'm not quite sure. And then you see in the Sirius case, something else, another way to look at these things is not necessarily what the statute says about benefit received, benefit performed, but which aspect of your business are we looking at? And that's why Sirius got overruled, is that originally they're talking about how Sirius puts out its signal and its platform and its programming.
Where the content was being produced, right?
Correct, which was outside of Texas. And then when it got to the Supreme Court, they said, whoa, we may agree with that, but we don't care. We think where the satellite radio itself is located is where your service is going to be received or performed. And that's a whole different ballgame. It's looking at a different aspect of what you do and then applying the rules. So there's really a couple of ways to look at it. What does the rule say? Is it subject to interpretation? And then which activity are we focused on? And that really opens up the door for opportunities to look at your business maybe a little bit differently. And as I said, I just had a client call me the other day. It's more on a sales tax question, but their accountant who referred them said they have a SaaS product. And I said, okay, fine. I looked up a couple states how they tax SaaS. And then I got a conversation, goes, well, we really don't license our software. It's not available. They give us information, we input it, we do all this stuff, and they can look at it. And I go, well, that's different than SaaS. So again, it's definitional. What are you actually doing? Can you segment the activities that you're doing? And is all your revenue tied to one type of activity? Is there ways to look at different types of activities, slice and dice it, and it might be different levels of being received or enjoyed or delivered. So there's a really, with these cases that are coming up, it's a time to re-examine what you do and where you do each of the components.
Yeah, and you know, in Sirius, what they ultimately did was they just elevated one of the items of income producing activity over all other, right?
Right, and what they didn't do then is look at, is it just a subscription? Is that you're paying for other add-ons? Is if you add on a Sirius subscriber, I have one for my RV, I've got one for the car, I've got one on a portable place that I can listen to, each with a separate fee, and they didn't break that down at all. So there are multiple generators of revenue, they just looked at the one.
And so, yeah, I mean, there's so much going on right now. So, I mean, we can follow this outline or we can jump into any piece that we want. But from an apportionment standpoint, I want to spend a little bit more time on that. Alternative apportionment is becoming more important as states' apportionment methodologies get trimmed down to being single sales factor market-based sourcing, right? Jordan and I were talking about this yesterday. And, I honestly think that if we were talking about like the platonic ideal of an apportionment methodology, it would be 3 factors with a sales, a payroll, and property, and sales would be market-based. That way sales is measuring, where your sales are occurring, but then property and payroll appreciates the fact that you have property and payroll. Now, going back to my point, examine your state and local tax footprint, see if there are states that jump off the page that don't make sense. I think it's much more likely that certain states won't make sense because of just certain types of distortions in the market. Whether it be the type of product you sell just happens to have a lot of central purchasing customers in state X, and that state is going to be distorted.
I would say, we've talked about this now, and Chris, you're a little younger than I am, but I remember, I wasn't around when UTIPTA was written, but the whole point of what you just said, property, payroll, and sales were used to reflect, mostly in a manufacturing business, but to find out where you developed your income. Where was your income generated from? And what they said is that they're all equally weighted, 1/3, 1/3. And that was based on economists' study of where people generate, how they make money. And because of political reasons and recruitment into states trying to create favorable taxing jurisdictions, we've evolved out of that. And, we're all familiar with the Mormon case, and the Mormon case was the single sales factor on its face unconstitutional, right? And now with the emphasis on the single sales factor and then this trying to understand market-based sourcing or even destination-based, I got to think that there's some distortion elements associated with the fact that we only use single factor. That's not, the question is, does it properly reflect your business in the state? From a sales perspective, it does, but from where I generate all of my income, maybe it doesn't. And maybe it's time to talk about as applied standard, which was never addressed in Mormon. And I think people have to, when you're protecting yourself here, something to look about is maybe, and you and I have cut deals with states where we have added elements, other elements into it other than the sales factor, because they recognize it's just not fair to have a single sales factor capture all of my income. There's got to be some other factors that are considered on all the different pieces of income. And I think that's something that comes down the alternative apportionment route because it's statutory single sales factor. But I'm pushing people, whether it's an audit, whether it's on refund, whether it's on a PLR, and you and I have talked about this. Now's the time, really, because of the devastation we have, to maybe push back on the acceptance of single sales factor. We know as facially, it's probably not unconstitutional because everybody, it divides up your
it's
business
internally
equally.
Consistent, right? We know that it can be internally consistent. The issue is, to me, where Mormon is kind of irrelevant in today's, world, is it was just, Jordan's 100% right. It was a facial challenge. Theoretically, I am in a COP state selling into a market-based state. That's the entirety of the transaction. COP grabs 100%, market grabs 100% of my receipts. That feels unconstitutional. And the court said, no, we're not going to look to what the other states do. We're going to apply this fiction. What if every state applied what the destination state did? And if that doesn't create multiple taxation, it's not unconstitutional. The issue is, okay, wait a second. I have all of my operations in one state, yet a destination state is claiming 100% of my income. Something about that doesn't feel right. There's no way that state, by just providing 100% of my market, but nothing to do with sort of where my base of operations is, there's no way that state can lay claim to 100% of my income. And I think that becomes the argument. And so there's the quantitative element, it's 100%, but then there's a qualitative element too, right? Let's examine what our operations look like and whether it just makes sense if it passes the smell test for a state to grab the portion that they are.
And just by way of example, we had a client come to us a little bit ago that we're working with where they said, listen, it was in our home state, my home state of Illinois, and they said, we're paying 12, 15% in Illinois. We've got 2% of our payroll, 1% of payroll. We've got less than 1% of our property there, and we're paying 12%. It just seems distortive. And we're working with the Department of Revenue, trying to come up with something. But they re-examined it almost through the prism of old eyes, of old three-factor, and said, hey, state, this doesn't make sense to me. And one of the things that they did, not quite sure it's been fruitful or not, but they reached out to economic development and said, listen, we'll never increase our presence here because you guys are sticking it to us. We need some help. And when you looked at it on a piece of paper and showed really how much of their business is being done in Illinois, the 12 or 15% was way overstated. Yeah. And Illinois recognizes that. We'll see what ultimately comes from it.
Yeah. So sort of moving on from the apportionment thing, because I think we could spend all day talking about
I agree. It's not an apportionment topic.
You know, are you taking 86272 protection anywhere?
And I will tell you this, and I'm on record. I think, you know, for those who've done the history on it, looked at the Willis report, without going into the whole discussion of PL 8622, it was basically formed as a temporary 6-month fix to a case called Northwest States Portland Cement, a U.S. Supreme Court case that found an Iowa taxpayer subject to tax in Minnesota, and they came out and passed this law. It's supposed to be a temporary fix to figure out what's going on. It protects sellers of tangible personal property. We're not going to go into the minutia of what 86272 is about. But that was in 1959, okay? The world's changed a lot, and there's a question as to why manufacturers, sellers of TPP have this protected position. I will defend to the death 86272 protection. It's a law, it's a federal law, it applies, it's still on the books. Do I think it's theoretically the right time to get rid of it? Maybe it is, maybe it's not. That's a different question. But what's happening right now, and we see the MTC involved in this, is they're trying to kill it by deaths by 1,000 cuts. And if you look at what the MTC is working on now, they're working on an 86272 project where they're talking about cookies and the existence of cookies in the state. If you have a cookie from your computer, your website, allows people to view it, does a couple of things, they're saying you go beyond 86272. Well, in my mind, that effectively kills 86272. So everybody's got a website. Everybody likes using cookies because they make things quicker, faster, more efficient. Don't do that, because what happens now is a bunch of us are going to be trapped into that. You know, someone's going to lose a case and all of a sudden the state's going to go out after everybody. Either expand it to include it in cookies, things ancillary to solicitation, include services, make it uniform across the board, or I got to tell you, get rid of it as of a certain date so we're all prepared for it. But to kill it slowly, state by state, nuance by nuance, I think it's bad planning. We don't get certainty, and I think it's going to stick it to a bunch of taxpayers who are normally protected by 86272.
Well, and this is the fiction that the MTC is adhering to as they put out new guidance on 86272. They're saying we're using the same analytical framework we always used, right? Is this activity ancillary to solicitation? I have yet to see any convincing explanation, though, as to why prior to the advent of the internet, 1-800 numbers, follow up, you know, if you could call the seller, ask them questions, that was never something that was going to kill 86272. Now the MTC is leaning towards saying it will, that is not ancillary to solicitation. This is a post-sale service that's being provided. And I have yet to see why the advent of the internet changes that answer.
Right.
That to me is a big problem.
You know, one of the things they talked about were frequently asked questions that are available on most websites, right? To make things easier. I've addressed this a million times. You don't have to talk to anybody. Look in the FAQs. They're saying, well, you're giving guidance that's beyond solicitation and therefore you violated 86272. Okay.
Well, and what they're also doing is they're drawing a distinction between sort of what I'll call like hard-coded FAQ, something that's written out and answered, versus does the chat box pop up and things like that. Here's the other reality. We all know, for anybody who's ever litigated 86272 case or defended an 86272 audit, Your salespeople are doing a lot more than you think they are, right?
That's true. Absolutely true.
An audit, I've had this happen before in an audit where an auditor says, well, let's call up one of your salespeople right now and ask what they'll do for me, right?
Right.
You're not gonna like the answer a lot of the time. States just are increasingly not liking 86272 protection. And while we all sort of rely on it and take that position, it's something to re-examine right now because it is an area of risk. And I think that allows us to segue pretty neatly into throwback and throwout, right? Now, is throwout consistent with economic nexus and market-based sourcing? I don't think so. I think that throwout doesn't work in that context. I will acknowledge throwback when the destination state is one in which your 86272 protected and it originates in a state. I can see how that works, right? You're making sure that the sale doesn't, that those receipts don't escape taxation. Fine. Throwout is unrelated to that. Throwout is artificially increasing your sales factor in a state, even where the activity has no connection to that state. And that to me is a real problem. And I really hope to see more challenges along the lines of what we see in New Jersey to throwout rules.
You know, and see, I disagree with you with throwback. My feeling is when the state has to look outside of its own borders to determine what is reasonably being reported to your state. So in the context of Illinois again, if Illinois has a throwback rule, they have to look at, I don't know, what your activities are in Minnesota to see whether you're truly protected by 86272. If not, they're going to throw it back here. They're not looking at what's being done in their state or what's being generated in their state. They're looking outside of their state to determine whether you're being taxed someplace else. That's not the job of the states. The states have determined a reasonable approach for activities occurring in their state, not what happens elsewhere. And so I even throw throwback back into there. And now, you know, with Whirlpool and those cases out of New Jersey dealing with throwout rules, you know, if I have an economic nexus standard, how can I not say that the destination state has an economic nexus standard and the fact that you're protected by a federal law? It's not really relevant. It's not really relevant.
Yeah,
So,
I can see that, but I also think that there is a legitimate government interest in taxing 100%, of making sure that 100% of a company's income is subject to tax.
well,
And 86270, the interplay between 86272 and throwback accomplishes that reasonable goal. So I understand your point that it shouldn't matter what's going on in a destination state. And I certainly would agree to the extent there's a destination state that say doesn't impose an income tax. There, I would say throwback's inappropriate. But where this, you know, these restrictions are enforced upon the states by federal law, I understand the role that throwback plays, and I do think it's legitimate in that context.
But I would agree with you if the states are going to be consistent and say, okay, we want 100%, but in those instances where it's greater than 100%, you mentioned it, a COP state into a market-based state where it's 200%, then they've got to back off. Have you seen the states back off? So, you know, they're talking out of forked tongues. We want 100% taxation. We want to hold you accountable. Oh, the fact that you're being screwed by another state, you're taxed there and we're taxing you, it's not our problem. That's the part that bothers me. Okay, so again, if we're talking about the idyllic world, the consistency of saying 100% is fine. Don't pick and choose your items. And that's all I'm pushing back on the state. So this whole throwback thing bothers me a little bit.
Yeah, fair enough. So I'll just throw this out there, actual tax asset, a benefit that is out there. I gave a presentation back in April now, I suppose. The months all blend together right now. But back in April, I gave a combined reporting presentation. And if anybody has further questions on sort of what Kentucky, New Jersey, New Mexico are doing, I'm happy to talk offline about it. But the more pressing issue is that all three states have provided a tax liability deduction. The recently failed Maryland legislation also had it. And what it effectively does is you look to, okay, in the course of combination, what happened to the tax liability? Did income go up? Did you go from loss to income, or did your loss get reduced? Whatever that delta is, you basically take 10% of that as a subtraction modification at some point in the future. And it's generally like 5 years from now is when you get to start taking that tax liability deduction. But you have to file an election to take advantage of the deduction much before then. Kentucky's date has already passed. It was July 1, 2019. That seems to me particularly draconian for something you're not going to use until 2025 or 2026. It seems like they're saying they're providing it, but then making, sort of trying to slide it through as fast as possible. New Jersey would be July 1 of the year subsequent to the year of first combined return. That makes sense. New Mexico has extended the election must be filed by January 1, 2023. So that's just something to put on your calendars. Do the modeling out, what's going to happen in the course of combination in these states, and make sure that you do file the election to get the 10%. I haven't heard any people who are concerned yet about missing the Kentucky date. I'm sure it's going to happen, and I'll be curious to see what the state's willing to do. But this is just something to be on the lookout for.
And something else we're seeing coming out of this period of time is some traps. This North Carolina case, it is North Carolina has an add back essentially for income that is not taxed income. And the question was, if I take a DRD at the federal level, it doesn't get included in my tax base for North Carolina. Do I get to add it back? Can North Carolina force you to add it back to eliminate net operating losses? And ultimately, the Supreme Court held that it was that DRDs, dividends received deduction, something we all take advantage of, is non-taxed income for North Carolina purposes, and therefore non-taxed income at the federal level can be added back at the state level. Again, it's kind of a trap for the unwary of what non-taxed is, your DRDs, extent that you don't pick it up. They impose penalties and interest because they now have a case saying they have to do it. It's not the only state that has this kind of non-taxed income add back, and we should be aware of those, particularly as the feds continue to give us additional changes through the CARES Act or through the PPP loan forgiveness, things of that nature, where you hear that they're going to be forgiven at the federal level. At state level, we're finding the states are pushing back and they're decoupling and they're not following it, and they're putting in categories where they can add it back and offset losses and or tax you. Same thing with
we'll talk about that a little bit more with the CARES Act and the NOL carryback.
Right. So the PPP loan forgiveness, that's an example of that. To the extent at the federal level you get debt forgiveness because you've used it to pay you paid your employees on all the required expenses during the 8 weeks you're supposed to pay it, and the loan gets forgiven. Well, that loan forgiveness is income. At the federal level, they're saying that's going to be excluded. We're not going to let you maybe deduct the expenses associated with it, but we're going to give you debt forgiveness, but not treat that as income. Is that income not taxed at the federal level? Perhaps it is, and might be an add back in all those states that have it. Something else that we've seen, just because cash is king right now, there have been a number of corporations that have declared dividends but have decided not to pay them or to defer them. That again, once you declare a dividend, just legally you have an obligation to pay it. To the extent that you don't pay it, it's considered a cancellation of debt and generates forgiveness income. Something that we've seen some people run into, not thinking about it. Well, we canceled the dividend, it's not a big deal, who cares? Our stockholders will be fine. Well, again, it potentially generates income at the federal level, and it may then also generate income at the state level. Something else that we've seen come up, and there are just some recent cases that were relatively harsh. To the extent that you are short of cash and you're not able to pay either a trust fund tax or a tax liability, if the company is failing, or in the edge of failing, it doesn't have the cash, they often go after the officers. Officer liability penalties will be coming first and foremost for businesses that have failed. And we've seen where one case here where the officer in charge was sick, they were out for 3 months. The son said, it was me, I decided not to pay it, was all on me, I'll take the rap. They got criminal charges brought against them. They still went after the assigned officer on the books and records, again, to kind of cover it. So we're going to see officer liability and states going after it in a much more severe way. Things to be concerned about. One of the things we've seen also is keeping your addresses up to date. There was just a recent case that came out that said it is the obligation of the taxpayer to maintain a correct address. To the extent that notices got sent out to a bad address, an old address, and went final is not the state's problem, it's your problem. One of the things that we could be running into are those Businesses that have less staffing, they're working from home. Notices are coming in. They're not getting passed to the right people. It's often an issue even if everybody is in the office. To the extent statute of limitations run, the protest periods run, things are becoming final. Through no fault of your own, the state issued it to the right address on file, but it's not getting picked up. We're hoping to get some forgiveness legislation with respect to protests and things of that nature when we've been forced to work home by state legislation, by state governor's decree. There's no one in the office. Try to get some forgiveness of that, a tolling of the statute of limitations to protests, something else to be concerned about. And just this last thing, it's been a bug up our butts. And with all due respect to the journalists of the world, they have been pushing for releases of audit notices, of settlement amounts. Freedom of Information Acts generally don't protect settlement offers. We've been finding lots of holes in the Freedom of Information Acts and confidentiality. And we're seeing settlements between us and the state and the government being released into the press, and it's nothing that anybody wants. So we've been very careful about what we put in settlement agreements, try to keep them minimalized. And sometimes now we are agreeing to settle things without a formal settlement because of the obligation under FOIA to turn those over to the public. And something you need to be careful about to the extent that you are resolving and settling things now with the departments of revenue.
Yeah. And this next slide, we could spend the entire presentation just sitting here doing corporate income tax issue spotting.
Yeah.
So I know we're kind of running closer to the end of our time, so we don't want to do this too long. We talked about the DRD issue in Wisconsin when Breen and I presented. There's just a lot going on there. The Tax Appeals Commission sided in favor of the taxpayer here in construing foreign dividends paid to a Wisconsin taxpayer as being subject to Wisconsin's DRD. Wisconsin is broadly taking the position that a lot of foreign entities do not issue common stock and therefore dividends cannot be paid on that common stock, and therefore the Wisconsin DRD is not available. The Tax Appeals Commission disagreed, and they basically said, no, it's treated as a corp for federal income tax purposes. We're going to treat these as normal common stock dividends. That issue is currently on appeal. Briefs have not been filed, but my understanding is they will, and the department's brief will be filed in the next week or so. But it's just an important thing to keep a lookout for, either if you're in the pool of taxpayers that has been assessed, and that pool is large, or what are you doing in terms of your DRDs in Wisconsin? Have you taken the DRD? Another big one is Illinois bankruptcy remote issues, and I'm sure this exists in other states. Illinois is a Joyce state, and a lot of taxpayers are taking the position that their bankruptcy remote structures, that those entities do not have nexus with Illinois. Now, Illinois has taken a fairly aggressive economic nexus position, but there's something else going on. These bankruptcy remotes are really investment assets that buy and sell and trade in securities. And Illinois has unique rules that actually require you to apportion such receipts to your commercial domicile. So we're seeing, I know a number of taxpayers have filed their own refunds on that basis. Others have been assessed on that basis, but that's an important issue going on. And then another one I'll just throw out so as to not spend too much time on this, and Jordan, if there's anything you want to add, is, we're seeing South Carolina right now invoke forced combination, basically saying, yes, we're a separate reporting state, we know, but we think separate reporting distorts your income, and we are going to force combination. And some of those cases have been more or less involved, where you see a transfer pricing study being conducted by South Carolina. Others seem very much more conceptual and high level, and just on the basis that you're separate, you've got a unitary business structure and you need to be combined. But it raises a really interesting question. If the unitary business principle is the linchpin of apportionment, and if you're subject to apportionment in a particular state, do you have a right as a constitutional matter to file a unitary combined return if the state's going to apportion your income? I actually think there's a pretty compelling argument that you do. This is an alternative apportionment. This is a constitutional right to file as a unitary business group. I've yet to see that case come up, but I think it's a really strong, compelling point. And of course, you would only use this in separate reporting states. And if you do that, it could facilitate the end of separate reporting, because the states will say, well, it's effectively an election to allow you to combine whatever you want. But something to keep in mind.
And just, I want to get to this. I know we got to run time. We got to do a polling question right after this. But I'll talk about, or you can put it up at the same time, but non-business income has actually come back as an issue. This Vectron case is very interesting, and just to be efficient with it, basically they had, let's say, 4% of sales into Michigan on a yearly basis. In the year that it's an audit or an issue right now, they had a major project where their percentage goes up to 80%. Because most of their sales are going to be generated for the year in that particular state. During the same year, they sell the business. And while we'll argue about it being business income or not, that's a different issue. The question is, does the 80%, when my traditional 4% is what I've normally done there, seem right? And Vectron argued that it wasn't, it was distortive. You can't look at the year of sale to determine that that's the right apportionment factor to use from a business income. And in my mind, it actually separates it out. We've got our normal operating business income, which gets apportioned the way that it gets apportioned. And then you've got this unique piece of income, call it business income, but a different type of business income generated by the gain of a unique transaction. It should be apportioned upon its own factors. What are those factors associated with it? And that's ultimately what the court did, is it sent it back down to remand to talk about alternative apportionment just for the gain, which I think is a really viable concept, because the sale of a business, the complete sale of a business, isn't based upon the normal selling of widgets. It's a completely different way of doing it. Who's involved in it, how you do it, how it gets sold are all different variables from where your normal widget buyers are. And what the court did is kind of opened up the door for us to look at gains and perhaps a different methodology to sell it, to apportion it, than even if calling it business income, than what you do on a day-to-day basis and how you sell your widgets. Very important case. And this Noel Industries, really quickly, fascinating. It's really a one asset company. They analyzed it. They got almost all of their income from their one asset. It was a 77% ownership of another company. And the question is, what happens with the gain associated with that? And they looked at it from an operational perspective, a functional perspective, a transactional perspective, and found that it was non-business income. Again, a pretty good decision for us to find non-business income when your sole asset, or the majority, your only asset, generates all of your income and it's still not to be found to be non-business income.
Yeah,
that concept is still alive.
It's a good case to read if you
instructive.
just want a primer on business income, non-business income.
But again, to accept that we're reorganizing our businesses, buying and selling different things, it's something to look for. And once again, give it up approach it under a non-business income, or as an income, as a business income proposition, but maybe should be apportioned in a different manner, a different way to look at it. Do you want to do a polling question? I think we got to do it.
Yeah, actually, because this is the time to do it.
Okay.
Okay, so do you, or feel on your own behalf or your client's behalf, feel comfortable with your tax compliance evolution in light of developments like the shift to market-based sourcing or Wayfair Nexus standards? I think this is an answer that, you know, a lot of my clients have a hard time answering honestly. So I'll give it a couple more seconds. Looks like we've got about 70% of response so far. Okay. So 35% yes, 3% no, generally comfortable 42%, and 20% think they made progress, but they're not there yet. That's probably about the breakdown I would have expected to see. So, you know, because we were running short on time, you know, indirect tax positions, this is really more of it's a CYA kind of a thing, you know, more so than looking for opportunities. We all know that refunds in the sales use tax context is fairly difficult, right? Even if you are entitled to the refund. You have concepts like voluntary payment doctrine, and you have issues like you have to refund those refunds to your customers. But, you know, especially now that I think most taxpayers are subject to tax in more states than ever before, making sure you've got taxability matrices in place, making sure you've examined your invoices for bundled transactions, that can allow you to reduce the tax base or to make sure that you can avoid, you know, unnecessary concerns on audit. Documenting exemptions, sales for resale, things like that. All really important to just sort of keep in mind as we move forward. And because we only have a few minutes, Jordan, unless there was something else you wanted to add, I would like to get into the CARES Act.
Yeah, why don't you go ahead and do that?
Sure. And, it's everybody wants to talk about the CARES Act right now because it's new, it's big. On the state and local tax side, it's much more important just from a conformity standpoint. What does the state's conformity look like? Are they conforming to the Internal Revenue Code as of a certain date? Do they only conform to certain provisions? Do they have true rolling conformity? A lot of states after the TCJA updated their conformity, right? Very few states have rolling conformity to IRC 172. Very few states allow for the type of carryback envisioned in the CARES Act. But it doesn't mean it's not going to have other types of impacts that really could mess things up from a state and local tax perspective. So just very generally, the CARES Act lifts the 80% taxable income limitation on NOLs. It institutes a 5-year NOL carryback for the dates that I've shown there. And really, there are very few states. I would say the biggest state that does have rolling conformity, and it'll be interesting to see what happens in light of some case law in the state, is Maryland. Maryland does have the type of conformity one would expect to see if you were entitled to use that carryback. Iowa recently came out with guidance specifically decoupling from any retroactive impact of the CARES Act. And New York has also pretty much completely decoupled from it. But there are some concerns, things you need to keep an eye out for. Importantly, and I think more important than the taxable of the guilty, being taxable in guilty states, is the impact that it could have on your statute of limitations. If you're going in and you're filing these NOL carrybacks for 5 years prior to 12/31/2017, you will have a change to your federal taxable income that triggers a reporting obligation in states. And if that happens, you got to know what that state's rules are with respect to opening the statute of limitations when you file an RAR. I haven't seen any states put out guidance on that issue yet. And the other piece is, like I said, in guilty states, in states that tax guilty, you could actually have a reduction of your FDII deduction when you use these NOL carrybacks. And if the state decouples from the NOL carryback but picks up what your federally stated FDII deduction is, you could actually have an increase in guilty income that's taxable in the state. So that's something else to keep in mind. I think the bigger money issue for most of our clients is the changes to 163J. Now, many more states conform to 163J than to 172. But and this is just a numbers issue. The interest limitation has been loosened from 30% to 50%. And as companies have rising debt, that's going to matter a lot. Like I mentioned with respect to NOLs, New York has said, no, we're sticking at the 30% limit. You have other states that just decouple from 163J entirely. But you have a lot of states that do conform to 163J on a rolling basis. So in those states, you will get the benefit of the increase. My prediction is more states are going to start decoupling from it. Look what Tennessee did, right? Tennessee conforms to 163J in 2019, but it does not pick up the 2020 changes. So, I wouldn't be shocked to see that happen more often. And I'm happy if anybody has any specific questions to kind of go into the weeds on what the CARES Act does. It's something we're all keeping on top of, but frankly, right now, the states just haven't put a whole lot out there. I got a really great question just a couple of days ago as to, okay, the 163J calculation, Michigan just put guidance on it. What do you do in a combined reporting state? Is it on a pre or post apportion basis? It seems to me that if you're going to pick up combined income, you should be able to use the 163J limitation on a combined basis as well, but not all states agree with that take. And then finally, having a minute and a half left is about all I think we need to address credits and incentives. There are a lot of compliance obligations with respect to maintaining credits and incentives. I'll just throw one out there that I was looking at just the other day. The Florida High Impact Performance Incentive Grant gives a $500,000 to $12 million grant if you put 50 new jobs, 50 million in capital investment into the state. If you fail to meet the terms in that agreement, which could be the capital investment or the employee triggers, based on the agreement you entered into with the state has the ability to claw back and impose penalties on you, right? So I think most states, in keeping with our discussion on voluntary disclosure and everything, are going to be willing to work with you. Look, so many people and businesses right now are kind of throwing out the playbook because just the rules were not built to anticipate this kind of event. But it's important to maintain open lines of communications with the states, with the parties in which you entered these agreements, and not just bury your head in the sand. And
Right.
Jordan,
No,
any thoughts?
no, in the States, so I did some research on this last year. I think it was 2018, maybe 2019. $50 billion were given out in tax incentives in the country, $50 billion. The states estimated they recouped $48 billion in tax revenue. It's a failed experiment, at least by some people's metrics. And I think they're realizing that. And so what you've seen are a number of states getting together saying, we won't compete with you, you don't compete with us, we're not going to fight against each other, let's not do that. And I had a list of states that have had legislation and or either accepted it or it's still in committee or at least they're looking at it. West Virginia, Florida, New Hampshire, Hawaii, New York, Kansas City, Missouri, Illinois, Arizona. So even non-contiguous states are trying to control the level of competition they have in neighboring states and states around the country to get out of this game of incentives. Now, obviously, incentives bring a lot of things in how they measure what a tax dollar is and everything else is different. Employment is good, structure is good, infrastructure is good, but you're almost seeing fatigue and a bounce back anti credit and incentive for a period right now. So hold on to the ones that you have. Be aware that states like California are trying to pass legislation for full disclosure of incentives. And a couple of states have already pushed that if you receive incentives, the state is obligated to publish who gets what. So you will be the target of various groups in the state about whether it's fair or not fair, whether you're complying or not. It's not our area of expertise, no bones about it. But for you guys, it's something to keep aware of, and particularly the extent that you've gotten incentives or credits, make sure you're doing everything in your power to comply and keep them, because I do think we're going to see a group of clawbacks coming back as a way of state to recoup whatever income they can.
Yeah, and so we're happy to field any questions either right now or offline. I do want to throw out one that Evan asked. He said, so if a state makes me pick up PPP loan forgiveness as income, would I also get to exclude some of the non-deductibility of the expenses related to the loans? So maybe we get closer to a wash with income picked up, but the expenses allowed. I would say not so fast. I'm not sure about the deductibility of those. I have not seen, well, again, we have not seen a whole lot of guidance come out from the state. But I'm not sure about, how far into creating our own sort of pro forma return in states do we get to go? They may simply say, we disagree that this does not constitute income. Now, will they do that in the form of just an administrative statement or a legislative add back? I don't know. But if there's a legislative add back, it would have to be coupled with some kind of additional deduction that would be imposed because it's obviously not existing at the federal level. So yeah, I think that's a really great example of we're still sorting out on the state level a lot of what this is going to look like. And so with that, unless there are any other questions, I just want to say thanks everybody for taking time out of your Wednesday to listen to us talk about state and local tax.
No, we appreciate it. Most importantly, everybody be out there, be thoughtful, be mindful, and be safe and be healthy. Thank you again, and we hope to see you in a couple of weeks.